you've just overloaded the regression. Okay, so on the regressions, kind of hold back on putting in everything but the kitchen sink in there. Today I want to kind of talk about the last topic in valuation. For 24 sessions, we've actually looked at companies from the outside in. You know what I mean by the outside in? We've looked at companies as investors. We've said, what does this company look like? You know, what's the return on capital? What's the growth rate? We've come up with values for these companies, looking at these companies as investors. You're saying, what other way is there to look at it? Today we're actually going to, so think about it this way. We're on the outside of a glass bowl looking in. We're looking at these companies. We're valuing these companies as is. Today I'm going to open a little door in the glass bowl. I'm going to let you in. You're going to run the company. So today we're going to turn the focus to how you might change the value of a company from the inside out. You're running the company saying, how do I increase? So there are levers now that we can get to that we couldn't have got to as passive investors. Today we're going to think like the managers, the owners of the company. Before I get started on this topic that I'm going to call value enhancement, I want to first emphasize that what I want to talk about is how to enhance the value of a company, not how to enhance the price of a company. Price enhancement and value enhancement are two very different ideas. You say, what's the difference? In an efficient market, the two should converge, right? You enhance value, the price should go up. But in a market that is not efficient, what you do to enhance the price of a company might have little to do with what you need to do to enhance the value of a company. I'm going to start off by showing you two graphs. These are separated in time by about 5 years. These are two graphs from two different studies. The first study was done in the late 90s. It's called A Rose by Any Other Name. Basically what this study looked at was it looked at a sample of, I think, 64 companies that changed their names. You're saying, big deal. Companies change their names all the time. These companies changed their name by adding .com to their names and did not change a single aspect of their business operations. They did exactly what they did yesterday, but they now call themselves whatever they were yesterday, .com. Okay? Let's think of it from an intrinsic value standpoint. Has anything changed? Same cash flows, same business, same growth rate, same risk. The value should be the same, right? Look at what happened to their stock price on the announcement of the .com name. Stock price jumped on average 150%. That's price enhancement. This is the peak of the .com boom. All you needed to do is add .com to your name. 5 years later, another study. This study also looked at companies that had changed their names. Now remember, this is post.com boom. The bubble has burst. These companies also changed their names. You know what they did? They took .com out of their names. What the market gives, the market takes away. In this case, taking .com out of your name pushed up your stock price 20, 25, 30%. That's price enhancement. You try to cater to markets. You try to give the market what it wants. You're enhancing prices. What I want to talk about is value enhancement because I really don't know what the market wants. I can't be feeding the market what it wants because markets constantly change their minds. So from the focus of value enhancement, to change the value of a company, you've got to go back and change something fundamental in the valuation. Remember, we said there are 4 pillars on which every value rests. The first is cash flows from existing assets. The second is the expected growth rate in those cash flows. The third is how long you can maintain high growth. And the fourth is the cost of capital. Every valuation rests on those 4. So if you're going to change the value of your company, you've got to change one or more of those 4 variables. You can try to increase your cash flows from existing assets by either running your business more efficiently or reinvesting less to keep the existing business going. You can try to grow faster by either reinvesting more or reinvesting better. You can try to keep your growth going for a longer period by building on competitive advantages, or you can try to reduce your cost of capital. What I want to focus on today is to take each of those pieces and talk about how you might change those pieces. So in a sense, we're talking about you becoming the CEO of a turnaround company, or essentially trying to change the company. What are some of the aspects from which you can extract value? Let's start with the first piece. So you come in as CEO of a business. You're looking around saying, how can I increase cash flows from existing assets? Let's keep it simple. If you think about cash flows from existing assets, it's operating income net of taxes minus net capex minus change in working capital, right? That's a definition of free cash flow. You can actually write operating income as revenues times operating margin. So here's the first place you're going to look. Remember those 2 words you hear after every big merger? Cost cutting and more efficient operations. Assuming you mean what you say. You know what I hear? Higher margins, same revenues, higher operating income. The reason I say assuming you mean what you say is you heard a lot of talk about cost cutting after mergers. You see very little delivered. We talked about this during the context of acquisitions. The easy costs get cut first, but the easy costs tend to be small costs. The closer the costs get to the top management, the more unlikely it is that they will actually get cut because it cuts too close to home. And I'll give you an example. And I've taught at J.P. Morgan now for almost 25 years. And for the first 11 or 12 years that I taught at J.P. Morgan, I used to teach their program at 37 Wall. 37 Wall is actually the building, the corner building right across from the New York Stock Exchange where J.P. Morgan himself used to sit. 37 Wall is the building right behind it. It's an old, decrepit building. So the way it would work is you'd come in this narrow corridor. You'd have to walk through a Gestapo, 2 security guards on each side demanding everything but your firstborn. Whereas your driver's license, last 3 years of tax records. Once you pass that gauntlet, you'd get in, and you'd be in front of this bank of 4 elevators. And for the first 12 years that I went to this building, I'd go in, and you'd stop, and there'd be this guy sitting in a chair right in front. Even though he was in his 60s, he'd sit in a chair. And as far as I could tell, this was his job. You'd hit the elevator button. The elevator would come down, and he would point. So why is he doing that? Is it because I'm blind? But if I'm blind, I can't see him pointing. Is it because I'm deaf, but I can't hear him pointing? Basically, there's the elevator. Get in. He never talked. Like that. So for the first 11 years and 8 months that I did this, he was there. Then in 97, J.P. Morgan had a bad quarter. CEO announces with huge fanfare that he's going to cut costs. A week later, I go back into this building. I walk by the security guards. I get to my usual spot. I turn around. There's an empty chair. There's your cost cut right there. That poor guy probably got his job because he saved J.P. Morgan from falling down a shaft or something 50 years ago. And J.P. Morgan said, hey, from this day on, you have a job for life. Just sit in the chair. Just point at the elevator. They probably paid him, what, $25,000 a year for this? This was the cost cutting. When people talk about $250 million in cost cuts, what you often see delivered are $3 million, $5 million, $7 million. But assuming you mean what you say, that you're going to really cut costs, which really, and this is pure fat that you're cutting, you should have higher operating margins, higher operating income. If you have businesses that are losing money that you expect to keep losing money forever, shut them down. You see, that's pretty stupid. They'd have been shut down already. People hate to admit mistakes, though, right? You make a big mistake, the mistake stays on. Notice how many divestitures occur when a new CEO comes in. Because the new CEO has no qualms about admitting to the old guy's mistake. Oh, mistake. He wants to clear the table so he can make his own mistakes. Nice clean table. But if you have businesses that are losing money, that expect to keep losing money forever, shut them down. What I'm going to say next is going to sound mildly unpatriotic and perhaps illegal, but I'm going to say it anyway. I have never believed it should be the objective of any company to maximize taxes paid to the government. But then let me fully cover myself. Within the constraints of the law, I think it makes complete sense for you to minimize your taxes paid. Notice I said within the constraints of the law. I hope that's on the webcast. Within the constraints of the law. Okay? You're saying, how do we do that? You could pull a Beyond Borg. Anybody here remember Beyond Borg? I actually played one very brief junior Wimbledon, 1976. I lasted, I think, 21 minutes. 6-0, 6-0. I won 4 points, all on double faults to the other guy. Grass is for cows. It should never have been intended for tennis, right? And Wimbledon, the ball hits the ground. Before you can even react, the ball's gone, right? But the good thing was I got to watch all of Wimbledon that year. And in 1976, a 17-year-old Swede named Bjorn Borg won Wimbledon. So the headline that year was, Borg of Sweden wins Wimbledon. Next year, he comes back. I wasn't there. But he repeats the process. And here's the headline. Borg of Monte Carlo wins Wimbledon. What the heck happened here? Did Monte Carlo invade Sweden while I was watching? Sometimes things happen in Europe. They slip under the radar. But I don't think it happened. So what do you think happened? You know what the marginal tax rate in Sweden was in the mid-90s? Oh, it was even higher than that. Remember, it was 60 in the U.S. It was something like 85. It was essentially, send me the check, I'll pass it on to the tax guy. And at some time in 1976, Borg probably spent some time thinking, do I need to be Swedish? I know ABBA might need to be Swedish, but I don't need to be Swedish. I could be Monte Carlo or Monacan. I mean, there are, let's face it, Luxembourg, Monaco, Monte Carlo, these are not countries. You drive through them, you can miss the whole country. Luxembourg, oh, I drove through fast. There's a whole country, it's behind me now. These exist to allow wealthy Europeans to find a way to shift their income. You're saying companies can't do this? Hey, they try all the time. Remember Stanley Works, the Connecticut-based company that tried to move to the Cayman Islands and got into a lot of trouble? It didn't succeed, but it was trying to get a lower tax rate. But you don't even have to move countries, right? If you're a multinational, you have some limited freedom to move income across your different subsidiaries. And guess what? Every European company has an Irish sub, and the Irish sub is always the most profitable unit of the European company. We sold nothing in Ireland last year, but we made 3 billion euros. How the heck did you do that? Very efficient operations. Maybe there's something to do with that 12.5% tax rate in Ireland. So within the constraints of the law, you're going to try to move income to lower tax locales. I'm not a great fan of risk management. I think there's too much risk management at companies, most of it ineffective. But one good output from risk management is you might be able to smooth your income across time, and if you can smooth your income, perhaps you can stop those spikes in your tax rate, which keeps your effective tax rate at a lower level over time. All of those things feed into the tax rate, which in turn can push up your after-tax operating income. So see if you can make your operating income higher by cutting costs, more efficient operations, divesting negative return assets. See if you can lower your tax rate. And let's take the CapEx. When we do free cash flow to the firm, we always subtract out the CapEx, right? But let's say you're a company that's over-invested in the past. In fact, you have enough capacity to service the next 3 generations. There is no law that says you have to keep doing CapEx. So if you can cut back, if you can live off the fat for a while, cut back on CapEx, go ahead and cut CapEx. Finally, you're a company that has a lot of inventory, a lot of accounts receivable, retail firm. One way you can extract more in cash flows is by having tighter management controls on inventory, on credit granted. Presumably by doing that, you reduce your change in working capital, increase your cash flow. All you're doing here is you're taking the existing assets and trying to extract more cash flows from existing assets. If you're CEO of a mature company, this is where you're going to try to get value, get more cash flows from existing assets. Second step in the process. You try to grow faster. But the way we've set up growth, we can't just throw a higher growth rate in an Excel spreadsheet. You have to earn higher growth, right? And there are 2 ways you can grow faster. One is you can try to reinvest more. The other is you can try to reinvest better. Let's take the reinvest more. To reinvest more, you can try to find more internal projects. But that's a lot of work to keep finding 20 more projects, 30 more projects. If you want to increase your reinvestment rate overnight, the easiest way to do it is to do a big acquisition. It's part of CapEx, right? It can make your reinvestment rate jump. This is easy. Let's just go out and do a bunch of acquisitions. We'll buy growth. At what price? That's where the second term comes in. If you reinvest more, you might grow faster, but your value might actually decrease as you grow faster. And the reason being, if you reinvest more in projects that earn less than your cost of capital, you're actually destroying value, not adding value. So if you're going to reinvest more, just make sure that your return on capital on those reinvestments stays above your cost of capital. It's not just about growth, it's about value. So you can reinvest more by either taking internal projects or doing acquisitions, or you can reinvest better by increasing the return on capital. In fact, we set this up earlier when we talked about EV to sales, but return on capital can actually be written as a product of margins and turnover ratios. So you can have a higher return on capital by either having higher margin on existing sales or trying to extract more sales from existing capital. Higher turnover ratios, either way you're pushing up the return on capital. If I made you CEO of a semiconductor company that's troubled, there might not be that much you can extract from existing assets and cash flows. This might be the place you go. You might say, look, I think I can grow faster, I can grow more efficiently. Let me see if I can find ways to either reinvest more or reinvest better. So increase cash flows, increase growth. Often when companies think about growing, they often think about all these different ways of growing as equal in terms of potential. But that's not the case. Okay? We actually know very little in academia about how much value different growth strategies adopt. That's why when people talk about growth strategies, they act like, oh, you can do this, you can do this, you can do this, and you offer 7 options. McKinsey, if any of you read the McKinsey Quarterly, it's a great magazine. Subscribe to it, it's free. So get on the website, link it up. They do some of the best work in corporate finance and valuation in terms of looking at historical data. This is from one of the McKinsey Quarterly articles a couple of years ago. And this is what the article looked at. McKinsey has collected data on hundreds of companies over time, many of them their own clients. And what they actually tracked in this article was the potential for value creation with different types of growth strategies. In other words, they're saying that, hey, you can grow faster by doing acquisitions, you can grow faster by introducing new products. Where is the potential for value increment greatest with these different strategies? So let's look across time. Okay? So here's how you can read it. First, it lists out the type of growth strategy adopted. So if you, for instance, grow by introducing new products, on average, every $1 million you invest creates $1.75 to $2 million in value over their database. And you can see the high end, the low end, what's typical, so new product. Of all the growth strategies, having a new product, introducing new product was the most value-creating strategy. Next, expanding an existing market. Every $1 million invested created about $0.3 to $0.75 million in additional value. So think of that like a net present value. Maintaining or growing the market share in a growing market, every $1 million invested creates about 0.1 to 0.5 million. So you're still in positive territory, but you're seeing it's becoming less attractive. Competing for share in a stable market. Notice something troubling? When you see the numbers pop up to the left side, what is it telling you? That's actually value destruction. About a third of the cases, when you're competing for share in an existing market, you might grow, but you're actually destroying value as you grow. And acquisitions, collectively, this is acquisitions across private and public, every $1 million invested creates the lowest potential upside and a fairly significant downside. So basically, you end up in consulting. You're talking to a company about growth strategies. Don't put all of the options on the table and say these are all equal. Because if you're going to grow through acquisitions, history suggests that the odds are loaded against you even before you start. If you are able to introduce new products, that in fact has been the most productive growth strategy, but it's also the most difficult growth strategy to pull off. I mean, look at Apple. Apple's success over the last 10 years has not come from going into the PC business. 10 years ago, a lot of strategists said what Apple has to do is go head-to-head against Microsoft for the PC business. Apple said, no, that's not where we're going. They adopted a different strategy. They went for new products, the iPod, the iPhone. That's where the value has come from. But it's also the most difficult strategy to pull off. So any questions on growth? So you can increase cash flows, increase growth. Yes? Yeah. No, wait. If you increase the reinvestment rate, you will add value only if what? No, but stop there. Increasing the reinvestment rate will not necessarily increase value. What's the other condition that has to be met? That the return on capital has to be great. So if you increase your reinvestment rate and you earn a return on capital greater than the cost of capital, then reinvesting more will create value. But if you increase your reinvestment rate, but your return on capital is less than your cost of capital, you'll actually destroy value. That's why acquisitions are an easy way to increase your reinvestment rate. But remember what we saw on Monday. Most acquisitions, you overpay. If you overpay, your return on capital already is below your cost of capital. That'll actually destroy value. So reinvestment rate, increasing the reinvestment rate is easy. Increasing the reinvestment rate while maintaining a return on capital that is greater than the cost of capital is much more difficult. Did I answer your question now? Let's talk about the third way of increasing value. So you can increase cash flows. I'm thinking in terms of an Excel spreadsheet, right? That's basically, I'm thinking of the FCFE Ginzu spreadsheet, saying, step by step here, right? So I've got the cash flows, I've got the growth rate. Third way to increase value is to increase the length of my growth period. You're saying that's easy, just make the 5 into 10, the Excel spreadsheet. That's true. You and I can increase value from nothing. But in a real company, increasing the length of the growth period goes back to what kind of competitive advantages do you have. I'm not a strategist. But looking at corporate strategy from the outside, this to me seems to be the way to think about the length of the growth period. You either come up with new competitive advantages, you augment your existing competitive advantage. Let me talk about 4 potential competitive advantages you might build on to increase the length of your growth period. We talked about the value of a brand name in the context of Coca-Cola. If you have a valuable brand name, nurture it, build on it. Because There are companies that have destroyed valuable brand names in the past. Companies like Zenith, Xerox, Quaker Oats. So if you have a brand name, don't look a gift horse in the mouth. This is your source of value, build on it. If you don't have a brand name, you might try to get a brand name. That's not easy to do because it's not just throwing more advertising money. It's a function of luck. It's being in the right place at the right time. But you can see companies trying. Google, for instance, I think is very seriously trying to work up a brand name for its product where people say, hey, that's a Google product. They haven't quite succeeded yet, but you can see it's a work in process. So if you have a brand name, build on it. If you can get legal protection from competition, would that be nice? Wouldn't it be nice if the government stepped in and said, we'll keep the competition out for you? In some cases you will, right? But be careful, though, what you have to give up in return. In fact, there were sectors in the U.S. where you did get legal protection from competition. Phone companies. They were regulated monopolies, right? But step back. If you were running a company, what's the great thing about being a monopoly? I mean, let's face it, as a monopoly, everybody hates you, right? But you know how you get back at them. You hate me 30% more for you, 50% more for you, 70%. It makes you feel a lot better about being hated if you can charge people more. But if you were a regulated monopoly like the phone companies, and like many power companies are still, when you get ready to charge people 50% more because they're complaining too much, what happens? You have to go in front of a regulatory commission. The regulatory commission says, oh, 3% for you this year. You're making too much money. This is the worst of all scenarios. You're hated because you're a monopoly and you have nothing to get back at these people with. If in return for legal protection against competition you have to give up pricing power, it's not worth the trade-off. Many telecom, if we go across the world, there are many parts of the world where people are bidding for telecom licenses to get a regulated monopoly. But in many cases, they're not asking the follow-up question. Once I get this license, will I be given unfettered power to set prices, or is somebody going to set prices? Now, the other version of legal protection against competition is what? Pharmaceutical companies, what do we see? Patents, right? So if you can get legal protection against competition, try to do it. In fact, remember Amazon tried to even patent one-click shopping? Right? They claim that they invented it. You know? People try to claim all kinds of things. It's amazing what people patent. And it's also amazing what some companies have let slip through without ever patenting. You sit in front of your PC, which is what most of you have, not a real computer. This spoken like an Apple user, right? And you play with your windows. And you use your mouse to move things around. Remember where it was invented. Where was it invented? It wasn't invented at Apple. It was invented at Xerox at a lab called the Park Lab. The lab in Palo Alto, where Xerox used to do it. So this is a lab where they put their technicians in, they started working with neat products. And they came up with the first mouse-driven interface. And of course, they thought this was the most useless thing ever created. This is what happened in geek set policy. They said, people will miss at typing in DOS, you know, the C:::, you know how you use MS-DOS used to be? Oh, how they can't just click on it. It'd be so boring. Xerox never patented that technology. Two Steves, Steve Jobs and Steve Wozniak, visited the Park Lab and watched these guys playing with the mouse. And they thought it was a pretty neat idea. And of course, they co-founded Apple. And the very first Apple came with a mouse. But to show you that nobody learns from their lessons, Apple didn't patent what they did either. So Xerox missed it, Apple missed it. In fact, 10 years later, when Microsoft came out with the first Windows, Apple tried to sue, and the judge said, it's not yours in the first place. You stole it from somebody else. You didn't even bother to patent it after you stole it. What I'm trying to say is sometimes companies they have the potential of legal protection, but they never test it out. They never check it out. So if you can get legal protection against competition, get it. Switching costs. You know what switching costs are? You want to make the cost of switching into your product as low as possible. And once people switch in, you want to make the cost of switching out exceedingly expensive. Every cell phone company plays this game, right? Just come on in. We'll do it all. 5 minutes, you'll have a new Verizon contract. And then you're indentured for life. You try to get out of that contract, $50,000. Oh, you didn't read the fine print there? Your house comes with the car. We have to claim it from you. But you know what? I don't blame them. If you're in a commodity business, which is what the cell phone business ultimately becomes, you got to figure out ways to create a competitive advantage. And sometimes you can shift a business away from being a commodity business. The software business in the early 80s was a commodity business. Commodity business in what sense? Anybody could go into the garage, write software, sell it on a. Microsoft decided to change the rules of the game in the software business. And they went about it very well. In the early 80s, what was the dominant spreadsheet program? Lotus, 100% of the market. I still remember working with Lotus and cursing them as I worked with them because they would never they would send patches on top of patches on top of patches to make the system work. Because they said, where are these guys going? What's the alternative? I still remember the first ad I got from Microsoft Excel. Incidentally, Microsoft produced Excel for the Mac before they did it for the PC. First ad. You know what the ad said? You can open Lotus spreadsheets in Excel. Cost the switching in as low as possible. So I switched to Excel because I was tired of waiting for Lotus to upgrade. Few months later, Microsoft introduces Word and PowerPoint, the first Office suite, masterstroke. You see what? Businesses switch into Excel, into PowerPoint, into Word. Then finally Lotus wakes up and says, we've got an upgrade. So let's say you're one of those companies with a false sense of loyalty to Lotus that goes back to Lotus spreadsheets. So now you're sitting there at your desktop working on a big document. You're using Microsoft Word for word processing, PowerPoint for your presentations, and you've now decided to go back to Lotus for your graph. So you take a Lotus graph, you paste it into your Word document, and the whole document disappears. It's gone. You can't find it. You call the helpline at Microsoft. The very helpful person comes on. And she asks you, are you by any chance pasting a Lotus graph into a Word document? And you say, yes. So, well, we can't guarantee that the two will work together. But you have two choices. Here's your first choice. You can switch back into Excel, in which case you'll have no problem. Here's your second choice if you don't like that one. You can switch out of Word, switch out of PowerPoint, switch into Lotus. Think about it for a moment. You think about those hundreds of documents you already have in Word and PowerPoint. No, I'm not doing this. Every day I wake up and say, I'm going to switch to Keynote today. You ever use Keynote? It's an incredible presentation program. Once you try to say, who the heck uses PowerPoint anymore? But then I think about the 1,800 PowerPoint files that I have, and just my mind starts crumbling. Because Keynote claims it can convert it, but the formatting goes all over. This strange things start happening. I'll have to go fix all those files. I'll stick with mine. Microsoft has me now. And I hate to say this, but they've got me by making the cost of switching out so incredibly high that I can't even think of the alternative now. It's made it almost impossible for anybody to enter any one of these areas by themselves because there's so much of a dominance here. It might change, but that's their competitive advantage. The final competitive advantage you might have is that you might have a cost advantage. If you have a cost advantage, build on it. How do you get a cost advantage? You could be endowed with it, right? Why does Aramco have a cost advantage? Because the Saudi Arabian government said all the oil under the sand here belongs to you. The fact that you stick your finger in the sand and oil comes out makes it incredibly easy for you. The oil company that is in Canada, poor guys have to go 15,000 feet underneath, get the frozen oil out, unfreeze it, and cost them $50 a barrel. It could be earned. Templeton Funds, for instance, had a tremendous cost advantage in Asia because they went into Asia about a decade before everybody else. They developed the first databases. They had analysts on the ground. So when Asia became hard in the 1990s, the Templeton Funds had a cost advantage they could build on. But whatever the reason for the cost advantage, there are two ways you can take advantage of that fact. One is you can charge a lower price than everybody else and drive them out of the business, right? But the problem there is the monopoly laws, the antitrust laws might kick in against you. The other is you can charge the same price as everybody else and walk away with a huge profit. This is the game that Dell fought against Compaq in the late 90s. In the late 90s, it cost Dell about 30% less to manufacture a computer than Compaq. Dell and Compaq charged the same price. Compaq barely broke even. Dell walked away with a healthy profit. But to show you that things change, it's no longer Dell versus Compaq, it's Dell versus Lenovo, and guess who has the cost advantage now? Lenovo has the cost advantage. The problem, if any of you are tracking Dell, you know the biggest problem Dell has now? Its biggest competitive advantage is gone. It's trying to figure out, every day you wake up and it's got a different strategy. What it's next? The one strategy they tried was they want to have stylish computers. What they did was there were red Dells, blue Dells, pink Dells, green Dells, yellow Dells, all kinds of colors. You know, we're going to be like Apple. Come on, you can't spend $15 after you've designed the computer, putting a color on the computer. I'm stylish now. It's not working. You can try for brand name, but I think outside of Apple, there isn't a single PC company. Remember the definition of a brand name. You would be willing to pay a higher price for the same product, right? The only PC company that can make that claim is Apple. You pay about 20 to 30% more to buy an Apple now than a computer of equivalent power, which is a PC. But every PC company brand names. So if you were in charge of Dell, Michael Dell says, I'm stepping aside, you come in and run the company, your first task is, where's our competitive advantage? Let's find it, because that's what's going to drive the length of growth period. So this is where corporate strategy meets corporate valuation. So try to reduce your cash flows. Try to increase your cash flows. Try to increase your growth rate. Try to lengthen your growth period. Reduce your cost of capital. When I say reduce your cost of capital, what's the first thing that comes to mind, especially if you're taking corporate finance? It's the most obvious way to change your cost of capital. Change the mix of debt and equity, right? That's one of four ways in which you can lower your cost of capital. Here's the second. If you have a product or service that is very discretionary, remember what it does to your betas, right? You have a high beta. If you can make your product or service less discretionary, you know what you've done to your beta? You've lowered your beta, lowered your cost of equity, lowered your cost of capital. You think, how the heck do I do that? How do I convince people that a product or service that they absolutely don't need is something that they cannot live without? Isn't that what all advertising is about? If you don't buy those Gap khakis, you will never dance again. If you don't drink Coke, you will never be happy again. I mean, most of the time the ads don't work on us. We're jaded, but one way to think about advertising, it's about lowering your beta. Maybe this is how we should judge advertising agencies. Estimate beta before, estimate beta after. Beta did not go down, sorry, you're not going to get paid. You didn't do your job. The other is you can try to change your product characteristics to actually make it something that people cannot live without. I mean, 6 years ago, if I asked you, can you live without your cell phone? Well, it's a secondary product. I need it. Today, if I ask you, can I live without a cell phone? Oh my God, my whole life is there. What will I do? I'll have no contacts, no calendar. I wouldn't know where I live. My name is in there too. I mean, there are people who say groceries or cell phone, and it's a hard choice whether you have to eat or whether you're going to give up your cell phone. It's become your life right there. It's moved up the ranks. Cell phone service might be getting close to non-discretionary. In fact, for my 14-year-old daughter, the only punishment that works is threatening to take away her cell phone. She completely melts down. Oh my God, don't take my cell phone. I will do whatever you ask me to do. Hey? To make your product or service less discretionary. If you have lots of fixed costs, remember what it does to your beta, right? Pushes up operating leverage, pushes up beta. If you can reduce your fixed costs, you in effect have lowered your beta. Remember those two big trends in the 90s, outsourcing and flexible wage contracts. You know, there's a lot of societal debate about both phenomena, but there is a basis for both. When you outsource something, what are you doing? You outsource your copy. You used to have 16 copy machines that you paid for and people to run the copy machines. By outsourcing those costs, you've made them variable costs. By having flexible wage contracts, what you in effect have done is what you pay to your laborers is a function of how well you do as a business. You've made your costs more flexible, more variable, which in turn pays off as a lower beta and a lower cost of capital. What I'm trying to say is you don't have to change your debt ratio to lower your cost of capital. There are other ways to get there. And here's a final way you can lower your cost of capital. If you've mismatched your debt and your assets, you know what I mean by mismatch, right? Using long-term debt to fund short-term assets. dollar debt to fund euro assets. Get rid of the mismatching. And it's easy to do today, right? Swaps, you have options, you have derivatives. Try to get your debt back into sync. By doing that, you reduce your default risk. Reducing your default risk lowers your cost of debt. Lowering your cost of debt lowers your cost of capital. Be creative when it comes to cost of capital. You don't have to run an optimal capital structure spreadsheet to come up with what's right for you as a company. Think outside the box. So here's what I'm going to do. I'm going to take a company and first value it as a passive investor. Then I'm going to ask, if I ran the company, what would I do differently? Let's take a couple of companies and try this out. The first company is going to be a bit of a challenge. You know why? Because it's already a pretty well-run, well-managed company. Company's SAP, a very un-German company. It's a technology company that's always at the front of whatever's happening. It's Oracle's main competition globally. So here's my valuation of SAP status quo. In fact, this is something you saw across all my valuations, status quo. What I basically mean is this is my valuation of SAP with the management that's running SAP today continuing to run the company, with all the good stuff it does and all the bad stuff it does. So I did a valuation of SAP. I won't bore you with the details, okay? But here's something that I want you to track. They're 99% equity, 1% debt. What I want you to think about now is, as you look at this valuation, is think like somebody is going to come in and run the company tomorrow. Look to see what you can change. So you should look at the cost of capital, the mix of debt and equity. You know what else you should look at? Look at what they're earning as a return on capital. And what are you going to compare that to see if they're doing a good job? You're going to compare to the cost of capital, 19.93, 8.68. Looks like that's not good news for you. You see why it's not good news for you? Because they're already taking great projects. There's not much room there. Maybe they're not reinvesting much. Well, they're doing pretty good, 57.4%. So that looks pretty good. You say, well, maybe they're growing in 5 years. Well, already they have a 10-year growth rate. They're building on their competitive advantage. One by one, all those levers we were thinking about seem like the only lever that seems to have some give in it here is what? The debt ratio looks like. Maybe they can reinvest a little more. The reason I'm saying that is when you're earning, 12% more than your cost of capital, maybe you can settle for 11% more than your cost of capital and take more investments. But already there isn't that much you're going to be able to do here that can dramatically change the value of the company. So here's what I did. I decided to take a look at the debt ratio. I know 2% sounds like a really low debt ratio, but I really don't know where to go because as a technology company, who knows what the optimal is? Maybe it's only 2%. So I went back to my capital structure spreadsheet and essentially computed the cost of capital at every debt ratio. Those of you in my corporate finance class remember this exercise, right? But if you are not in my corporate finance class, let me take you through the exercise. I started with the unlevered beta, computed the beta at every debt ratio. So as the debt ratio went up, I computed the levered beta, which pushes up the cost of equity. I computed a synthetic rating at every debt ratio. And as my debt increases, my interest expenses go up, my rating starts at AAA, drops to C. As my rating drops, my cost of debt goes up. I do start losing tax benefits, past 50%. I don't have enough income to cover the interest expense. But there's my after-tax cost of debt. This second to last column is the key column. Basically, it tells me what's going to happen to my cost of capital as I go from 0 to 10 to 20. And initially, the benefits of debt outweigh the cost. In fact, when I get to until I get to about 30% debt, my cost of capital decreases. And then the costs exceed the benefits, cost of capital starts rising again. So that first initial reaction we had that the debt ratio was too low is confirmed. They could be at 30%, they're at 2%. So I decided to revalue SAP. Here are the changes I made. I moved the debt ratio to 30%. I was realistic. I adjusted the beta for the higher debt ratio. I adjusted the rating for the higher debt ratio. My cost of capital is significantly lower now than it was before. The value per share I got before was 106 euros per share. With this change put in and a slightly higher reinvestment rate. One of the weaknesses of SAP is they don't have much exposure in Asia. They haven't looked at the Asian market as seriously as they should have. So I did assume that they would reinvest more, and much of that would be in Asia. But to be realistic again, if they invest more in Asia, what's going to happen to the risk premium? It's going to go up. So what you have to do here is you can't just selectively pick the good stuff and not look at the bad stuff. I am making them reinvest more in Asia, but pushing up their risk premium. I am making them borrow more money, but pushing up the beta and the cost of debt. The net effect, though, is by making these changes, I increase the value per share about 20 euros. That sounds like a lot. But this is, in a sense, my best-case scenario. I'm trying to get blood out of a stone here. And to be quite honest, if you ask me to come into the company, I'm going to say, no thanks, there's not much I can do in this company. It's already pretty close to being well run. The only area where I think there's significant potential for improvement is by changing the debt ratio. Any questions? So this is a firm where the only potential value increase is debt ratio. Patrick. Because the managers hate debt. And a lot of technology companies, there's this deep-rooted unwillingness. Why doesn't Microsoft borrow money? If you look across the sector, there is this aversion to debt that seems to be almost endemic. And it reflects their age as companies as well. These are young companies. Still, many of them are run by their founder owners who essentially do not like to be interfered with in what they do. And if you take on debt, it is going to come with restrictions on where you can go, covenants, things you might not want. So their reaction is, let's just go with that. So it's not unusual for managers to get set in their ways. And in the case of SAP, what are you going to do? There's not much you can do to move managers in terms of once they've decided not to borrow money, that's what you're going to be stuck with. Any questions? Let's take a much easier company to turn around. This is Blockbuster. This was about 3 or 4 years ago. The reason I picked this was there was a news story that led me to pick it at the time that Carl Icahn was interested in Blockbuster. And of course, Carl Icahn, since he's interested in really bad companies, this is a good choice. So this is Blockbuster status quo valuation. Take a look at the valuation. Tell me where you see the biggest problem. The value per share I get is $5.13. Look at the return capital. Once you see that, you should start dancing on your table. This is a good company for me. Because all you need them to do going forward is to do what? Is to earn the cost of capital. I'm not asking for miracles here. I don't think Blockbuster is going to earn excess returns, but is it too much to ask the company to say on your new projects, please, please, please pick at least zero net present value projects. Don't open that Blockbuster store even though you're going to lose money, please. That doesn't make sense. So this is tailor-made for our intervention, right? In fact, here are the changes I made to Blockbuster. Okay? I just pushed the return on capital, cost of capital. I said that's all. If you can do that, then the rest of your problems become trivial in relation. With that change, look at what happened to value per share, $12.47. $5 status quo, $12.50 with the change in management. That's a pretty huge change, but the reason the change is so larger is this is a company with a lot more going badly for it. Coming in and changing it then means just pushing up the return on capital to the cost of capital. I'm not saying it's going to be easy operationally to do it, because they're in a bad business. Netflix is eating away at the business in one half. Walmart is eating away at business in the other half, because Walmart started renting out videos for $1 a piece, and Netflix is cooler for people to rent from, I guess. So you have to figure a way out of this box, but at least you have your task laid out in front of you. Yes? We'll talk about that, because I have two values now. The question you're asking is where will the price fall between these two values, right? Which will be a function of what is the probability that they will actually make this change. If there's zero probability that they will make the change, they're stuck with the $5, and the price obviously is going to be 5. But the reality is the probability is going to fall somewhere in the middle. We'll talk about how to assess that probability and bring it in, but we have two different values. In fact, I would argue that for every company we value, there will always be two values, a status quo value and an optimal value. The companies you picked, right? You did a valuation. You said, if I ran the company, I would do things differently. This is your chance to do it. Go in and fix it. Make it your company. See what you get as a value. If you have enough of an ego, you should end up with a value high. If you consistently keep ending up with values lower than the status quo value, see a psychiatrist. You have some serious issues with yourself. But if you're allowed to run a company, you should be able to find a place where you can change. So this is what I'm going to use as my vehicle for talking about the value of control. To me, the expected value of control is a product of two things. One is the probability that you can change the management of the company. The second is how much you can change the value of the company with the new management. We've already talked about how to do that, right? Value of the firm run optimally minus the status quo value is how much you can change firm value. The probability that you can change the management of a company is going to be a function of several factors out there. First, it's going to depend on what kind of takeover restrictions exist in that market and that company. This company might have voting and non-voting shares, which makes it impossible for you to change the company. It's going to be a function of voting rules and rights, how essentially you change the company. It's going to be a function of access to funds. Do you see why access to funds matters? If you're going to change the management, you might have to borrow money, raise fresh equity. If you're in a market where raising fresh capital is impossible, it might be difficult to change. And finally, it's going to depend on the size of the company. It's easier to change management at a smaller company than a larger company. But those two key numbers will drive the expected value control. So here are the factors I would think about. If you gave me a company and said, what is the likelihood that the management of this company will change? I'm going to look at institutional factors, institutions that operate around the company. Restrictions in capital, restrictions by the state. Many countries, and even states within the U.S., used to have laws designed to prevent takeovers. Often written for parochial reasons. German companies do not want to be taken over by French companies. Pennsylvania companies do not want to be taken over by New York companies. I don't know whether that was a motivation, but that the states actually passed laws. Right. You're also going to look at the potential inertia here, because when you approach an investment bank, say, I want to change the management, if nobody seems to care, the investors are all out sleeping, much more difficult to change the management of the company. And finally, it does help to have the Carl Icahns of the world kind of hanging around the edge, because they help make this much more likely to happen. Firm-specific factors, one is anti-takeover amendments specific to the firm. You can look at the corporate charter. How difficult have they made it for me to change the management of the company? If the company says you need 2/3 of the votes to change the board of directors, there's an anti-takeover amendment. It's going to depend on voting rights. If you have two classes of shares, it's obviously far more difficult for you to change the management of the company, because the voting shares are often held disproportionately by the incumbent managers. You don't like the way News Corp is run? Sell the stock and move on. You're not going to change the way it's run. It's Rupert Murdoch's company. So in a sense, if you have two classes of shares, that already gives you some sense of the likelihood of change in the company. It also depends on corporate holding structures. What kind of, you have minority holdings, majority holdings, cross-holding structures, pyramid structures in Asia to keep control kind of entrenched, and whether you have large stockholders and managers, and whether they're part of the incumbent management team. You don't like the way Oracle is run, again, move on. There's not much you can do, because Larry Ellison owns 26% of the company, and he's the CEO. He's not going to turn on himself. It's a terrible CEO, I'm going to get him out because it's him. Okay? So you're going to look for that. So the probability that management will change will be different across companies, but it'll also be different across time. Okay? So you'll actually see that when markets are doing really well, the probability of changing management drops off because everybody's happy, inertia kind of kicks in. So it varies both across companies and across time. And one of the challenges in valuation is figuring out what that number looks like now and what it might be in the future. So in valuing a company, I actually like to come up with the numbers. I want a probability of control changing. Here are some of the things that empirically seem to have made a difference. So this is from studies that have looked across time at companies where management has changed and looked to see what variables predict that change. Biggest factor that seems to predict management changes is what's happened to your stock price. Companies where stock prices have gone down dramatically, you're far more likely to see forced management changes than companies where stock prices have done well. It's a function of the structure of the board. If the CEO is the chairman of the board and it's loaded up with insider directors, you're far less likely to see change than if the CEO is if the chairman of the board is an outsider and you have a lot of outside directors. It's a function of ownership structure. If you have a lot of institutional holdings, you see more forced CEO changes. Not because the institutions are necessarily more activist, but if they get pissed off, they can do something about it. Whereas companies with a lot of individual high insider holdings, much more difficult to change management because the insiders tend to be the people running the company. And finally, it seems to be concentrated by sector. You'd often see hostile acquisitions kind of bunched up in a sector, a lot of chemical companies, a lot of steel companies. Once the process gets started, you seem to see more changes occurring within that sector. So here's what I'm going to do. I'm going to use what we've talked about as a mechanism for talking about the value control in 4 scenarios. I'm going to talk about in the context of hostile acquisitions. Okay? Then I want to talk about valuing publicly traded firms. Why the probability? I'm going to argue that embedded in the market price of every publicly traded firm is the expected value control. That when you pay $16, $18, $20 per share, you are paying something for control. And paying a premium on top of that might be a double counting. I'm also going to talk about voting and non-voting shares and how the expected value of control determines the difference between the two. So if you come to me with two classes of shares, I should be able to say, well, this company, voting shares, should trade at an 8% premium, this company should trade at an 18% premium. And finally, I want to talk about minority discounts in private companies. Essentially, the price you pay for 49% of a private company will be far lower than what you pay for 51%. That's called the minority discount. I'm going to try to quantify that discount. So let's take each of those areas and talk about how the expected value of control comes to play. Hostile acquisition is clearly the most direct and easiest way to deal with value control, because in a hostile acquisition, the probability of management changing becomes 1, because once you do the acquisition, you're going to replace the management. That's why you cannot have control be a motive in a friendly acquisition. You see why? Because when you say control, what are you saying? I don't like the existing managers, they're doing a terrible job. The minute you say that, it's unlikely that it's going to be a friendly merger, right? Because those managers are going to fight you tooth and nail if you try to take over the firm. So in the case of Blockbuster, its stock was trading at about $9.50 in July of 2005. If you were going to do a hostile acquisition, you would be willing to pay up to $12.50 for the share, because that's what you think the stock is worth. So if you're doing a hostile acquisition, that optimal value becomes your ceiling on how much you're willing to pay for the company. Of course, you have synergy and other factors you can add it on top of that, but that's how it plays out in a hostile acquisition. So in this case, for instance, the premium you'd be willing to pay is $297. We talked about it in the context of acquisitions. If you pay the $297 entirely as a premium, though, you've done the dirty work of fixing the company. Blockbuster shareholders are going to walk away with the benefits. So you've got to think about how you would demand a share of the premium for yourself. And we also talked about what will happen if you think it'll take you 3, 4, 5 years for the premium to show up. All you need to do then is take the present value of what you think you will get, the present value of $297 in 2 or 3 or 4 years. Right? So hostile acquisition is pretty straightforward. The probability of control changing becomes 1 because you take the firm over. Here's the second. As I said, I believe that the market price of every publicly traded firm is embedded in it the expected value of control. And let's go back to the Blockbuster case. The stock price was $5, the status quo value is $5.13, the optimum value is $12.55. Let's assume that I was right on both, because that's an assumption here, because I made it, those are both estimates. Let's say I was right on both those numbers. I also told you that Blockbuster's stock price was $9.50, right? In a sense, I've told you what the market has attached as a probability to control changing in this company. Here's why. The stock price today is the status quo value times which is $5.13, plus the probability of control will change times that difference in value. So I have the stock price, I have the status quo value, I have the optimal value. If I solve for the probability of control, it looks like the market is attaching a probability of control changing of about 60% to Blockbuster. Incidentally, the $9.50 stock price occurred after Carl Icahn showed up. Before he showed up, one day before, stock price is $8.20. Now do you see why the appearance of an activist investor is all you need for the stock price to jump, right? So you have a company, you have a status quo value and optimal value. Those numbers don't have to change, but the very presence that an activist investor brings to the process is they change the probability of control changing, which in turn will mean the market price changes. It's interesting because if you think about it, this actually happened in Brazil about 5 or 6 years ago, when Ambev was taken over by Inbrew, as part of a hostile. It wasn't a hostile. It was an acquisition. It was a premium paid, but all of a sudden you started to see more. The differences between the shares start to widen, between the voting and the non-voting shares widen, because in that particular merger, the voting shares walked away with the entire premium. The expected value of control going to it. People seem to learn from this, and you can see the premium start to widen. But when you see the market price of a company, you're seeing embedded in that price the probability that control will change in the company. Now, one thing that I think has changed in the last year is clearly activist investors have gone underground. They don't have the money, they don't have the presence that they did a year ago. Private equity investors like KKR and Blackstone are licking their wounds. You can actually argue the probability of control changing now is far lower than it was a year ago. And even if nothing has changed, the market prices have to go down to reflect that probability. Any questions on market prices and the probability of control change? I'm actually going to use that to come up with the value voting shares and non-voting shares. I'm going to make an extreme argument, and then we'll kind of see what will happen if that extreme argument doesn't hold. I'm going to assume that that there are two classes of shares. So you guys are going to be the voting shareholders. You guys are going to be the non-voting shareholders. I'm going to assume that the voting shareholders have complete and total power over the firm. They don't basically have to talk to you. They don't have to consult with you. They can essentially claim all of the surplus for themselves. We'll talk about why this might be an extreme assumption. If you think about valuing the two classes, so if you have non-voting shares, voting shares in the same company, you guys have complete control, you have zero control. Which one should trade at a premium? The voting shares, right? So the task I'm trying to assess is how much of a premium. Now, as non-voting shareholders, I gave you two values, right? Status quo value, optimum value. As non-voting shareholders, you get a share of the status quo value. None of the optimal value because you don't control the firm. You can't change the way the firm is run. You, on the other hand, as voting shareholders, get the status quo value, but on top of that, you get that expected value of control divided by just the number of voting shares. So you get the entire price. See already the implications? If a firm is already perfectly managed and perfectly run, what should voting shares trade at relative to non-voting shares? They should trade at the same price. The worse run a firm is, the bigger the difference should be between voting shares and non-voting shares. Hey, rather than talk about this in abstractions, let me actually give you an example. I did this for Embraer. This was about 5 years ago. I did a discounted cash flow valuation of Embraer, status quo value, came up with 12.5 billion reais as my status quo value. I revalued Embraer and came up with 14.7 billion, more aggressive investment policy, more aggressive financing policy. So I have two values. At the time that I did this valuation, there were 242.5 million voting shares and 477 million non-voting shares in Embraer. So here's what I'm trying to assess. How much of the non-voting, so this is like the end of your DC evaluation. You come up with the value of equity. Normally, how do you get value of equity per share? You just divide by the number of shares. But now you have two classes of shares. So the question is, how much are you going to assess the value? First step in the process is I'm going to try to assess the value of the non-voting shares because that's going to be my base. To assess the value of the non-voting shares, I'm going to take the 12.5 billion, which is my status quo value. Because as the non-voting shareholders, you get no share of the optimal value, and divide by the total number of shares outstanding. Voting and non-voting shares. Which means my status quo value, or my non-voting share value, is going to be 17.38 reais per share. To assess the value of the voting shares, here's what I'm going to do. I'm going to take the 17.38 as my base. To that, I'm going to add a probability that control will change. This is small because of the voting shares here, which is, I think, one of the trade-offs here, is because you're voting shares, they get all of the expected value of control, but because you have voting shares, you also reduce the probability that control will change. There's only a 20% chance that control will change, times the difference between the two valuations, 14.7 minus 12.5, divided by just the voting shares. That gives me a value per share for the voting shares of 19.19. Based on my estimate, the voting shares should trade at a premium roughly 10% higher than the non-voting shares. Louis? Well, this is an intrinsic value per share. I can then compare to the market price. I can look at the market prices, right, and try to back it out. But let's suppose I ask a different question. I'm trying to decide whether to invest in Embraer non-voting shares. I have to decide whether the price I'm paying is too high or low. So I have to do a discounted cash flow valuation of the company and decide how much the value per share is. This is an intrinsic value per share for the voting and the non-voting shares. Once I have these values, I'm going to go to the market, look up the prices at which these shares trade, and decide whether they're cheap or expensive. So that will drive my investment decision. No, you don't see one price. You actually see two prices, right? So you see Brazil, actually every company will have two. So common shares and preferred shares. You can actually buy either at different prices. So there are conditions under which one share might be overpriced, the other might be underpriced. So this is the process by which we make that decision as to whether something is undervalued or overvalued. It adds a layer of complexity to intrinsic valuation that we normally don't deal with because we act like there's one class of shares. In this case, there is a difference in control. It's got to be priced. Yeah. The combined value, and actually what happened was the combined value of the two shares was higher than the values of the two shares independently. And that's exactly what you'd expect, right? Why? I mean, you say, why should it be different? If you just add the two numbers up and divide by a total number of shares, the weighted average, what change do you think as a result of having one class of shares? the probability of control changing actually went up, and that got reflected as a higher value per share. In fact, if I'm selling this to Brazilian company, this would be my sales pitch. Is if you're a company that's badly managed and badly run, and I'm looking at your company now and I'm saying, hey, you know what? I can't change the way this company's run. I have no power of this company. Your price per share for both classes of shares is going to be pretty close to the status quo value. By combining these shares and essentially opening up the process, you increase the probability of control changing. Downside, of course, is you're the incumbent managers. This basically means you could be out of a job. So you make the trade-off. So you can already see that the trade-off might not work in favor of the adjustments. But that's exactly what happened, was there was an increase in the combined value. But I think it was because of probability of control change. Golden share of the government. It does affect the probability of control changing in both scenarios, but you could argue that the probability of changing, it might be still low, but it was high. It is still higher than it was before when there are two classes of shares. Any other questions? Yes. That's actually a good question, because here I've made it stark, right? If the voting shares have all the power, non-voting shares don't. There are two ways in which non-voting shares can still benefit. One is they can piggyback on the voting shares. If the change is made within the company and the company becomes better managed and better run, then you get an adjustment. This is almost an all-in equity. So somebody else is making the change. I'm assuming that the existing management will not make the change, that it has to be an acquirer company to make the change. And this is a scenario where the acquirer buys just the voting shares and pays a premium, and you are left outside as a non-voting share. And that's why the Brazilian government actually has laws on takeovers that they've put into place, where if you're a non-voting shareholder, you're forced to get a they're forced to pay a premium, because if you don't do that, this is exactly what's going to happen. So because of those laws, you should expect the difference to narrow, not to zero, but to a smaller number, because I will have to share some of my spoils with you. So that's basically the voting and the non-voting shares. Let's talk about minority discounts. Right? Let's say you're valuing that private company. In this case, let's say it's a candy company. Come up with a value of 1.6 million for the equity in the company with the existing management. 2 million with the optimum match. Status quo value 1.6 million. 2 million is the optimum value. I offer you 40. I'm the sole owner of the company. I offer you 49% of the company. You see what the significance of the 49%? You have 49%, I have 51%. I still run the company. So 49%, what's the most you're going to be willing to pay? You're going to be willing to pay 49% of the status quo value, because you don't control the company. If I offer you 51% of that same company, you're going to be willing to pay 51% of the optimal value, because it's now your company. Look at the difference. 1.02 million minus 784,000. That 2% difference in percentages translates into almost a 20% difference in value, because one gives you control and the other doesn't. This is actually a big issue in private company valuations. You're trying to sell 30% of a business, you have to accept a big discount than if you're willing to sell 51%. But it's going to manifest itself even in publicly traded companies when you see large block transactions. 25, because you don't have to have 51% of a publicly traded company to actually control it. You could control probably 24, 25%, because that's a large enough block. You're going to see premiums start to be paid on bulk, because you are getting a portion of the control of the company. So value control is part of the game in almost everything we do in valuation. Even if you're valuing just a publicly traded company and not an M&A, I think control is kind of the story that drives your price. If your company has voting shares and non-voting shares, you have to confront the value of control. The final note is be careful about what you add on and what you net out. I've actually seen people do a discounted cash flow valuation of a company and then knock off 20% because you're getting a minority. They call it a minority stake in the company. They actually knock that. You know what's wrong with that? If you did your discounted cash flow valuation with status quo numbers, you already built in the minority discount, right? So when you valued a publicly traded company with all its warts, with all the problems it has, you're already valuing the fact that you have a minority stake. If you reduce that value by another 20%, you're actually double counting the fact. So be careful what you add and knock off after the fact, because you might be dealing with control in the wrong way. You might be double counting it, miscounting it. Do it right. Value control, do two valuations, status quo, optimal, deal with it directly. last thing I want to talk about is this is what every consulting firm, you know, process. I mean, when you look at McKinsey, you look at Stern Stewart, you look at BCG, you look at Bain. This is the cream of the consulting money, is to go in and provide value enhancement advice to companies. And as you can see, it's old-fashioned discounted cash flow valuation. The problem, though, is if you're a consulting firm, you go with an old-fashioned discounted cash flow model. They say, well, we could probably do this on our own. So every consulting firm over time has invented its own acronym for what they do and claims that this is the new, the best, the most advanced way of approaching value enhancement. In many cases, what they're trying to do also is replace that elaborate discounted cash flow model with a simple measure, CFROI, EVA. Basically, if you look at this one number, then you're going to be okay as a company. They basically want to give companies a magic bullet. If you adopt this, everything's going to be okay. I'm going to make the argument that while these rules are simpler on their face, there are disadvantages that you face because of these rules. To do this, I'm actually going to use one vehicle that actually became very, very popular in the 1990s, EVA. I mean, some of you might be familiar with EVA already, but if you're not familiar, let me define. You're going to see how trivial the whole measure is. It's a difference in return on capital and cost of capital multiplied by the capital invested in the company. So here's what Stern Stewart, the company that invented EVA, said. If you have positive EVA, you're doing a good job. If you have negative EVA, you're doing a bad job. And this struck CEOs as remarkable insight. How do you get a positive EVA? Take a look at the equation. What has to be true? Your return on capital has to be greater than the cost of capital. So what Stern Stewart was saying is, if you have a return on capital that exceeds your cost of capital, good job. The return on capital lower than the cost of capital, bad job. And CEO said, oh, I've never thought about it in this terms before. You mean my capital actually has a cost and I have to make more than the cost? Yes, that's exactly what we're saying. So that's what EVA is. CFROI is like an internal rate of return. What's different between EVA and CFROI is CFROI is based on cash flows as opposed to earnings. EVA is based on return on capital, which is based on operating income. CFROI is based on cash flows. In fact, in its more sophisticated version, it's an internal rate of return. You make some assumptions about the whole company as if it were a project, and you solve for the internal rate of return. And once you get the CFROI, guess what you do? You compare it to your cost of capital. If it's higher than your cost of capital, you say, good job. If it's lower than your cost of capital, you do. This is capital budgeting, that very first lesson we get in corporate finance, kind of pushed up to the corporate level. The bottom line is, no matter how you slice and dice this, you can't change the equation that drives value. The value that you get for a firm should be exactly the same, whether you use EVA, CFROI, NPV, basically it's the same equation kind of moved around. So here's what I'm going to do. I'm going to take a company, a very simple example, and kind of show you that what I get as my value with EVA matches up exactly to the nth decimal point to the value that I'd get with the discounted cash flow model. So here are the basics. This firm has a book value of capital of $100 million, is expected to generate a return on capital of 15% in perpetuity with a cost of capital of 10%. So I've given you capital invested, return on capital, cost of capital. This company also is going to make additional investments of $10 million every year for the next 5 years. So the capital base is going to build. And those new investments are also going to earn 15% for the next 5 years. Beyond the 5th year, the company will keep making investments, but its investments will earn the cost of capital. So for the next 5 years, it will continue to make new investments. Beyond the 5th year, it will make new investments. Those new investments become zero excess return investments. So let's think about valuing this firm using EVA. What's EVA right now? 100 million of capital invested. You're making 5% more than your cost of capital, so you're making 5 million, right? If you make 5 million every year forever, the present value of 5 million every year forever at the 10% cost of capital is 50 million. So I start with the base, book capital. To that, I add the present value of EVA from existing assets, which is 50 million. So I've got 100 to 150. Then I take each slice of new investments you're making, and I compute the present value of the EVA from those investments into perpetuity. So you have 5, 4.55. You add them all up. The value of this firm is 170.85 million. How come there's nothing after year 5? They keep making investments, I thought, after year 5. But what is it about those investments that makes them irrelevant? They earn exactly the cost of capital. So the value of this firm, so if I was Stern Stewart, I'd put this up and say, value of the firm, BVA, is 170.85 million. But let's suppose I value this firm using an old-fashioned discounted cash flow model. Instead of focusing on the excess returns, I'd have computed the free cash flow to the firm every year, right? This is what we traditional DCF valuation. I would take those free cash flows to the firm and my terminal value, discount them all back at the cost of capital, and what I get as a present value, remember the old value is 170.85? Is 170.85. There should be no surprise. I'm working with the same numbers, I'm just slicing them and presenting them differently. The one advantage of EVA is it does tell you where value comes from. Value doesn't come from growth, it comes from excess returns. The reason I don't count the investments after year 5 is they do not make it makes explicit what we've been drumming in DCF valuation, and it's in the background. By looking at excess returns, it forces you to think about what do I make over and above my cost of capital. But the end result should be the same with both. Yeah. Yeah. So what? It's the same. It doesn't. It's all illusion, though, right? It looks like in the terminal value. Oh, you know what my terminal value in year 5 here is? It's my book value marked up with the new investments. That's what my terminal value is. If you work out the math here, that's what my terminal value is going to be. So instead of looking at the book value today, I'm looking at the book value 5 years from now. Adjust because there's no excess returns. My terminal value is going to be exactly what my book value capital is going to be in 5 years. So it looks like it's a bigger number, but I'm just looking at a base that's the same in both cases. In one case, I'm starting with today's base. In the other case, I'm updating that base to make it a 5th year's base. So mathematically, it's exactly the same number, just presented slightly differently. I mean, that's how the present values work out. So here's the bottom line. It's the growth that creates value, it's the excess returns that create value, not the growth per se. The reason we don't care about growth forever is it doesn't add to the value of the firm. Now the reason EVA scared me was once Stern Stewart got into CEO's office and showed them, look, all you need to do is on your table is have a return on capital number, a cost of capital number, a capital invested number. And that's what CEOs demand. For me to tell me your return on capital, cost of capital, capital invested. They started tying compensation contracts at these firms to year changes in EVA. And now we're playing with dynamite. You see why? The minute I tie your compensation to EVA, I'm saying if you deliver a higher EVA next year than you did this year, you get a bonus. I'm going to argue that the prompt EVA happened because of that step of tying, of looking at year-to-year EVA changes. Especially when you look at divisional levels and when you think about trying to compute EVA at a divisional level, it becomes incredibly painful. In fact, here are the 3 games you could play. These are bad games from my perspective as an investor, but the 3 games you can play to make yourself. So this is a very perverse exercise we're going to go through. These are things you can do to make your EVA higher while making my value as a firm lower. First game, I'm going to call it the growth game. What does EVA depend on? Return on capital, right? After-tax operating income divided by capital invested. If you can make this year's EVA go up at the expense of future EVAs, you still get the bonus because I'm comparing this year's EVA to last year's EVA. So in the growth game, you give up growth to make your EVA this year higher, and in the process, you collect your bonus and ruin my company. Here's the second game. What's EVA? It's the difference between return on capital and cost of capital, right? But then it gets discounted back at the cost of capital. But if I forget to discount, if I'm just looking at the EVA per se, the difference, you could play the risk game of shifting me to riskier businesses, deliver a higher dollar EVA, but the present value of that EVA actually becomes lower. You're actually making my company less valuable while you collect a bonus. And the third is the capital invested space. What's EVA? Return on capital minus cost of capital divided by capital, multiplied by capital invested, right? If I can make my book capital lower, I will make my return on capital higher. So how do you do that? Depends on what you count in book capital. If you forget to count leases as part of book capital, you know what I'm going to do? I'm going to lease everything. I'm never going to borrow and buy because it increases my capital investment. Artificially, I make it look like I'm delivering a higher EVA, and I walk away with the profit. So basically, the growth game, the risk game, so the trade-offs here is you walk away with a bonus, I walk away with a lower value for my company. So keep that in mind when you see EVA being used in compensation. That can happen. The other thing that scared me was there were portfolio managers who started jumping on the bandwagon and saying, if I buy stocks with a high EVA, then I should make money. In fact, this got so deep-rooted that there was a guy at Merrill Lynch called Richard Bernstein. He was actually, he just stepped down, I think, a few months ago because he was worried about where Merrill was going to end up. he actually did a study where he looked at whether investing in the companies with the highest EVA delivered a higher return. Okay, so this is actually looked at company highest ROC, different. He looked at different metrics. There is your EVA. If you pick the companies with the highest EVA, the return you'd have earned would have been 12.2%. On the S&P 500, you'd have made slightly higher return. If you just bought companies based on price to book, price earnings, you'd have earned an even higher return. Picking companies with the highest EVA was not a great investment strategy. You can see why, right? It's like picking companies with the highest growth. Is that a good investment strategy? What determines what happens to the price next year? It's not whether your growth is high or low, it's whether it's higher than expected or lower than expected, right? It's not EVA per se that should drive your stock price. It's what that EVA is relative to what was expected to be. So the bottom line is, I don't have a problem with any of these measures fundamentally. They could work, but at the same time, there are so many flaws in here that it's easy to get caught up in these measures and they start driving the way companies. I'm going to leave you with something about EVA, something about how strongly this is sold. At the height of the EVA phenomenon in the late 90s, I was asked to be master of ceremonies at a conference that they had in Europe somewhere on different consulting firms and the value enhancement devices they use. So, and on the podium you had Boston Consulting Group, Stern Stewart, and McKinsey, three of the biggest value consulting firms at that time. So I was a master of ceremonies. I was supposed not to, so basically I should have just sat in the background, which I hated to do. But I just sat there, and each person from each, so McKinsey actually was Tim Kohler, one of the co-authors of the McKinsey Valuation book. He came in and talked about how McKinsey approaches valuation. He gave a fairly tempered response. This is how we think about valuation. These are the pluses, these are the minuses. Very well done. So he sat down. Then Raleigh Thomas, who was the lead guru in Boston Consulting Group in developing CFROI. This is how we do CFROI. These are the pluses, these are the minuses. This is what I think it does well. This is where it fails. It sits down. And then Bennett Stewart, who used to be one of the co-founders of Stern Stewart, got up. And this is an audience of European CEOs and CFOs. And he holds up the Coca-Cola annual report. He says, do you want to be like Coke? I thought a lot of CFOs said, do you want to do Coke? And, oh, yes. No. But these are, especially in the late 90s, Coca-Cola had been this huge success story for 18 years. So I was like, yes, we want to be like Coca-Cola. Coke uses EVA. This is like one of those high school logic problems. A leads to B, B leads to C. Use EVA. And he sat down. And I was steaming. There's nothing I could do there. But I was ready the next time I ran into Stewart somewhere in New York. So I knew I was going to be in a panel with him. I knew he had his prop, the Coca-Cola annual report he's going to hold up. So I came with my own props. I came with a bowl of Wheaties and some new Nikes. So he does his pitch, and so it's my turn to talk. And this time, since I'm not master of ceremonies, I can say whatever I want. So I sit down at the front table. I pour myself a bowl of Wheaties, and he says, what the heck is this guy doing? And I take my shoes off and put on my Nikes. And say, look, you know what? I've eaten my Wheaties. I'm wearing Nikes. Somebody point me towards a basketball hoop. I'd like to slam dunk the ball. Now, after all, Michael Jordan eats Wheaties. He wears Nikes. He can slam dunk. I can't get within 3 feet of a hoop, to give you some sense of this. I can eat all the Wheaties I want. I can wear all the Nikes I want. I can try slam dunking. Oh, I'm just going to whack my head against that side. Okay? What I'm trying to say is, what made Coca-Cola a great company had nothing to do with their adoption of EVA. They were a great company in the 80s and 90s because they went after investments that earned high returns, and if you do that, the value is going to take care of itself. The fact that they adopted EVA somewhere in the 90s was kind of an afterthought. If you adopt EVA, you're not going to become Coca-Cola. It's a measurement device. It's like a thermometer. The thermometer is not going to cure the swine flu. It'll just tell you you've got a really high temperature. So don't mistake measurement devices for solutions to problems. What consulting firms offer are measurement devices. To solve these problems requires a lot more work. So I will send you the spreadsheet to fill out. Please send it back to me before. The earlier you send it, the better, because I don't want everything to arrive Sunday night, because it'll be too overwhelming for me with 2 classes. So if you get finished early, just send me the numbers. If not, do it when you can.
So I had a question. So I'm taking Workers class also in behavioral finance,
Right.
and when you were talking about the value of control, one of the things that kind of came to mind was the idea that okay, well, the assumption is that markets are efficient and that ultimately I would be able. Okay, so we determine the probability